and welcome. You're watching the Mutual Fund Show, and working with your portfolio or, of course, managing your portfolio during these turbulent times can be quite a task. To help us understand what one should do with the way the NAVs are falling, Santosh Joseph, founder of German Investor Services, and Anant Ladha, founder of Invest Arch for Kal, join us. Thank you, gentlemen, for taking the time out to talk to us. And let's start with you, Santosh, first. These are very tough times. We've all been talking about a correction that's been coming, but for whatever it's worth, the last 5 to 7 days have been tough. Markets have declined substantially. Portfolios have declined even more. Most portfolios are trading lower, and that could be a little bit of a concern for investors. Santosh, start by telling our viewers and investors what should they do in a situation such as this? Should they just hold on, not look at their portfolio, or would it be wise to start nibbling in and adding allocations further in an incremental manner?
Good afternoon. Great to be on the show, and it's nice we're talking about tough times when in the last 7 days we've seen this kind of activity. It's interesting that by and large for the last few months, most of us were waiting for a correction. And when the correction has finally come in this form and fashion, we're all now beginning to get spooked, wondering, how deep this correction is going to be or how tough the times have been. Now, for most of us, this bit of correction is, we're not used to it. By and large, month on month, week on week, and especially for the last 4 years, we've been in extremely positive and a buoyant markets. This experience that what we are seeing for the last week or 7 days is classical of the markets, that when it starts turning around, it gives you those tough, scenarios where you really wonder, am I in the right place? Did I do the right thing by investing? Or should I pack up right now? Or should I sell everything and buy when the markets have settled out? The simple answer to all of this is, this is exactly what markets do. They tend to actually give you that surprise twist or turn. Now, mind you, the surprise twist and turn is what we've been enjoying for the last few months, where markets have been inching higher and higher and higher. The last 1 week, yes, markets have reacted to a lot of global news, from China getting a lot of flows to the war in the West Asia. So this is the challenge that markets will test you with regularly, time in and time out. For all of the investors watching this, please remember, this is classic markets. Stay put, stay invested. There may be challenging times, but markets will get better of it.
Right. Anant, what do you recommend? Would you recommend investors to take some profits off the table, or do you recommend they should do nothing and just sit tight?
Hi, firstly, thank you so much for having me on the show. Always fun interacting for long-term investors, specifically mutual fund investors. I remember that last month also we did a similar show with you guys, and there I strongly discussed that if you have overexposure in small caps and mid caps, you should probably book that amount. If you are an aggressive investor, you can do 18 months STP back into the same fund. And if you're a defensive investor and you feel that your risk profile is mismanaged and you are aggressively invested in small caps, you should probably shift some amount in your large cap allocation. So right now also, I have just 3 simple points to discuss. Firstly, look at your risk profile. If you just because market was trading higher and they were giving positive returns, you have been seeing 30% plus CAGR in last few years in small caps, and you feel that if you are over allocated in small cap, follow your risk profile and stick to your basics. Secondly, right now, we are not even 10% down from the top. So obviously, there is nothing to worry about. You should stay focused on your long-term goals. Just maintain your SIPs. Just in case if you see further volatility on the downside, for example, if you say 4 to 5% more volatility on the downside, probably that might be an opportunity for you to double down on your SIPs and use this dip as an opportunity. And finally, make sure that you have proper asset allocation in place. Gold, debt, these are equivalently important funds, specifically in the bad days. They'll help you stay invested for long term. So just be focused on your long-term risk profile.
Santosh, so if investors have money sitting on the sidelines, because I know there were a bunch of investors, bunch of fund managers from mid to late last year, where we were talking about how expensive the valuations were and had taken cash calls. Now, if you have that dry powder available on the side, do you think it may not be such a bad idea to upfront some of those allocations, or now may not be the time just yet?
So the guys who've maintained a cash call seem to be very happy right now because they took the cash call and the market is kind of responding to the cash calls that they have taken, at least that they have got it right. Now, usually when these kind of corrections happen, what all of us are looking for is when will it settle down? Therefore, it won't make sense to buy everything upfront, whether you're investing new or you got dry powder and you want to invest. I think it just makes prudent sense to start staggering or nibbling into stocks and investments which you felt were good but were expensive, but now the market has given you maybe a 5-7% dip already. As it keeps dipping more, you can start buying in more. So the answer is not to jump in at the sign of first correction, but if you wait, you may still get a better averaging out or maybe better price to enter in. But clearly, you should be watching out for opportunities.
Keep an eye on opportunity. Now may not be the time to double down, but there should be better times around when you may get a better entry point. Anant, you talked about diversification, and I think diversification should be undertaken at an asset level as opposed to a product level. So let's talk about the asset level, because there is an impending rate cut. There's definitely an MPC meeting this week. Whether or not we get a rate cut is anybody's guess. Do you feel like now could be the time, given the sort of run-up that equity markets had seen before this 5% correction, rebalancing your portfolio and increasing allocation of debt may be a good idea?
See, I feel that you should follow your asset allocation on a yearly basis. You should have a set timeline where you'll be reviewing your portfolio and deciding on your initial asset allocation. There's a very interesting data which I was just reading just before our show. If we check out the returns of all the emerging markets in 21st century and compare the equity returns with gold returns, probably India is the only market where gold has underperformed the equity market. Other than this, all the emerging market, if we check out the returns in local currency percentage wise, then gold is giving better returns than equity. What my conclusion is, always have gold, debt, equity in a proper combination according to your risk profile. This will help you sail through difficult times. So if you feel that today you are over allocated to equity because markets have rallied in last 1 year, then yes, probably you should take out some money from equity and follow your asset allocation. See, if you look in short term, probably asset allocation might not be that fruitful for you, because in short term, you might see some positive jerks on the equity market and you will feel that you missed out on the rally. But when you will look from a long-term perspective, probably 3 to 5 year perspective, you will always feel and come to a conclusion that having a proper asset allocation is a blessing in disguise.
Santosh, what are your thoughts on this? Do you feel like the current market mood warrants investors to rebalance their portfolio and potentially increase allocations to debt in anticipation of a rate cut from the RBI? Not today, but over the course of the next couple of months.
Well, I think there are two ways to look at this. Number one, asset allocation should be the starting off point of your portfolio construction. You do not build or change asset allocation because the markets have reacted differently. You start off your portfolio by understanding what is the asset allocation we need. Choose assets that are complementary to each other, that will act differently when the markets perform differently. Now, we are at a particular juncture where markets in equity are, taking a bit of a breather, and a fixed income is looking attractive. This is the point where you'll relook at your portfolio of what you've already started to figure out, do I want to do something tactically to the strategic portfolio that I already have? So you should already have fixed income allocation to your portfolio depending on your profile. If you feel that yes, rate cut is going to happen and I want to benefit from it, then you actually increase or decrease based on the medium to long-term view that you have. Do not react to the markets to changing asset allocation. You begin by building a robust allocation to help you navigate this market volatility, the changes that could come by periodically. Therefore, helping you navigate markets better, and also give you opportunity time and again that if there is an opportunity of small tweaks that can help you be sharper, tuned to the market and get benefit of it, that's when you actually change your asset allocation. Otherwise, it's a little bit of a boring exercise where you maintain a larger team going for you for a long period of time.
Santosh, I want to talk about another sort of idea that's doing the rounds in the last couple of days with the way China has been performing, or Hong Kong for that matter. Do you feel like geographical diversification is important? And the reason I ask this is because while we've seen a secular bull run on the Nifty, this is truly not reality, right? At any given time, if we do go into a correction mode, there is a good chance that there could be some of the market, case in point Hong Kong and China, that could do well. Do you recommend retail investors to consider adding maybe the Hong Kong ETF, maybe some of the global funds such as the Edelweiss Hong Kong fund, China fund?
So the interesting part of this question is that returns of the asset or the market always drives attention. The fact that for the last 2 weeks, 3 weeks, we're all talking about Hong Kong and Chinese market is very evident from the fact that they have just run up so much in the just last few weeks. Now, very simply put, historically, I have been a firm believer that we have to invest in international assets, at least to a small percentage of our overall portfolio, because let's put it this way, even at a very aggressive level, we are about 3 to 4% of the global equities market. Therefore, the Europe, American, and the Chinese market all put together form a far larger subset of the global equities market. Now, whether it's China today or at some time US and at some point UK and even the South Americas, we have a bigger market that we can tap into, which give us the diversification, which give us a play into global markets. Rather than now saying, should we look at China, it was always better to have some exposure to global markets, developed markets, emerging markets, some part of the portfolio. Now, it's nice that people today suddenly realize, hey, even the Chinese market can do well. We had a 2 year slow or no activity from them, and today we are looking at it. So therefore, having international allocation from an investor whose portfolio profile matches so is good. Rather than chase return, it's better to be invested before, so that when the returns happen, you benefit from it.
Right. Anant, you talked about diversifying into gold. Would you diversify or recommend your clients to go out and have some allocations made to markets such as China and Hong Kong?
Interesting question, but I usually feel that investing in a Chinese market or maybe Hong Kong market, or for that matter in Japanese market, are probably for super aggressive investors. If you are a normal investor with a normal, decent, moderate to aggressive profile, probably you can invest in S&P or Nasdaq index. That will give you exposure of a better index, which is more stable and which consists of a better set of economies and companies. So I would personally recommend investing in S&P as compared to Chinese market. As on date, I know Chinese market have performed really well, but looking at the past history of China, they are quite unpredictable. So looking at the aggressiveness of their decision making, I feel investing in Chinese market is probably only for super aggressive investors who even understand the risk associated with it.
Right, so that's one coming in with the recommendation that it might be a good idea to have a geographical diversification. Remember, of the 100%, 98, 99% of our portfolio does have a home bias. So a little bit of an allocation may not be such a bad idea at this stage. And it doesn't necessarily have to be China or Hong Kong, but of course, funds that cater to the global marketplace. Santosh, the other one that stands out for me right now, and I'm assuming that there has been a little bit of rush towards these balanced funds. These generally, by the nature of the product, are an expensive investment. But the fact is they provide you the asset allocation, which may or may not be suitable for a particular investor, because a lot of this is a cookie cutter approach. Do you feel like now may be not such a bad idea to add a little bit of balanced funds to one's portfolio if you don't already have any exposure to debt in that sense?
Yes, I think you said the term right. It's a cookie cutter approach, and most people are actually fitting into a product and the product fitting into what they need. Now, also thanks to the way the products have done in the past, most people think that with having fixed income and equity allocation, if my returns are going to be closer to equity, I'm happy with that. And that's why people have been so warmly embracing the whole hybrid funds and balanced advantage funds. I think the biggest reason why someone should look into balanced advantage fund is if they are not able to, one, make a decision about what segment of fixed income to be in, two, they do not know how to navigate between when to enter and exit into fixed income. Now, for those investors, balanced advantage was a great advantage. Now, coming into the situation right now we are in, if you want to make most of the markets right now and you want an equity exposure, then you have a different set of funds. But getting into balanced advantage funds today because you want to benefit from fixed income, I don't think balanced advantage will give you that advantage, because the fixed income portion in balanced advantage is to give you a hedge for equity performance or underperformance thereof. I think if clients are looking for an upside in fixed income, I think you're better off choosing those dedicated fixed income duration or corporate bond funds. But balance advantages for those equity investors who want a little bit of fixed income included into the portfolio, not so much just to make that extra return on fixed income, but to give you a protection for equity through fixed income.
Anant, are there any specific opportunities or undervalued stocks or sectors that one could consider investing in? Even though I do agree that thematic funds may not be ideal, because in that case you need to take two calls, right? One is the entry call and the exit call, always a tough one. But nevertheless, anything or anywhere that you see opportunity?
So presently, if you look at the market capitalization of top 10 stocks, you can even consider top 15, top 20 stocks. They are at the lowest level as compared to overall market. So investing in large cap can be a systematic way to check out some of the stocks which are comparatively better placed as compared to small caps. Secondly, IT and banking, for that matter, has been underperforming in the recent past. Whenever you are taking a sector call, I always believe you should look out for sectors which have been systematically underperforming and you have chance of getting some alpha. For example, if we look at defense or PSUs, they have performed really well, although they have corrected a bit in last 3-4 weeks. But overall, they have performed, or rather outperformed the market. So you don't take a tactical call or a sector call in a fund which is already outperforming. This is what usually happens because recently also, as per the data, majority investment is going in sector funds, that too in the funds which have outperformed. I feel you should take a contra call whenever you are looking out to take a sector call. Probably IT and banking might be the bunches where you might get some opportunities, and large caps obviously are better placed as compared to small caps and mid caps.
Right. Let's talk about market, the style of investing and type of funds. Santosh, up until maybe a few months ago, passive investing was turning out to be quite the chosen route, at least for large cap stocks, where generating alpha by active fund managers was a little bit of a challenge because there's very little information arbitrage. What I've seen is some of these passive mutual funds have lost significantly in the recent past. Do you feel like this is a short-term blip, and passive investing could still be a good low-cost mechanism for investors to build the large cap side of the portfolio, or do you prefer active fund managers in that space? And all of this in context of how volatile the markets are and the fact that I do believe that we've borrowed returns from the future with the recent rally that the markets have seen in 2024.
So yeah, there's no taking away from the fact that we've seen so much of returns front-ended of in the next year or so, and therefore any return expectation should be in moderate, even though there's a correction that we are witnessing right now. Now, the first thing about passive investments is that, number one, it's easy, it is DIY, and also low cost. Now, stretching it to passive investments and active investments, thinking that we can perform or underperform, I think is not the right comparison, because actives have a role to play in terms of generating an alpha. There was a period of time where actives were not able to generate an alpha, and particularly in the large cap space, and passives were catching up there and they were growing and ballooning. Over the last 2 to 3 years, we have enough data. Almost 80-90% of the large cap funds have comfortably beaten the index funds with outperformance. And that simply came because of the skew that the market had. And as the skew started reducing, the active funds in the large cap space started performing. So I think the debate between active and passive is not so much so to do with whether we're going to outperform or we're going to beat the index. I think it's about what the investor wants. If someone wants to not worry about which call to take, which call not to take, whether you want to benefit from the upside that an active fund manager can give, low cost, do it yourself, long term investor who doesn't want to look at his portfolio, then passives still have a place for you. But if someone wants their portfolio to be very actively managed, very nimble, and in participation with how the market dynamics are, there's enough room for actively managed funds across category, large, mid, and small, to generate an alpha and to generate excess returns for you.
Right. We should start wrapping up this conversation. But Anand, before I do that, and I guess this is an important question because, investing has got so much to do with emotion and discipline as opposed to strategy for most investors, right? And at a time like this, when every headline, every news channel is talking about how the markets are declining, valuations are concerned, China is the big problem, and of course the geopolitical stress. What and how do you think investors should deal with emotions and of course ensure that they are working with a strategy as opposed to getting emotional and sensitive and about their investments?
I feel whenever you're emotional, data will help you out. There are two interesting data which I can share here. Firstly, if you check out data of last 25 years, there were only 3 years where you had a correction of less than 10% in a particular year. So what I mean to say is every year you will see minimum one correction of 10% plus. So you have to be mentally ready for it. Secondly, if you talk about the Iran-Israel thing which is going on, the global confusion or the global war situation which is right in front of us, firstly, I don't feel that other countries, specifically USA, will play an important role and further deteriorate the situation. But even if it happens, I will love to share the example of Kargil war. Just before the war, market fell by 13%. But eventually market rallied in next 4 months by 41%. So yes, war-like situations, extreme situations will create market volatility and you have to be ready for it. But corrections are temporary, growth is permanent. You have to keep this in mind. But at the same time, you have to be rational towards your asset allocation and you will be good to go.
Santosh, how can one ensure that their investment decisions in these volatile markets are driven by strategy and not by emotion like fear or greed?
I think we have to be honest with ourselves, all of us being humans. We are prone to emotions. And I think that's why, sometimes we are so happy when the markets are doing well and we are sad and gloomy. In fact, most of us who are on WhatsApp groups realize that suddenly when the markets are not doing well, the WhatsApp groups go eerily silent. And when the markets are doing well, there is messages and there is outbursts of joy. It is first of all essential to understand we are emotional beings and we make decisions, or we are prone to emotional decisions. So there are 2 points to this. I think I agree with what Anand said, that data helps us be grounded, that even an excessive return is not sustainable, and even an excessive correction is not going to be sustainable. You rightly put it, saying that the correction is temporary but the growth is permanent. That's exactly the nature of the market. The second part, and this is a critical part where more often times we ignore this, is we need to seek or get professional help or an outsider to help us. Now, that's where, advisors and mutual fund distributors or even people who can help you manage your wealth become critical, because they are now using all data and information available to help you stick to your ground or stick to your investment mandate. The winner in such a decision is going to be the guy who's standing longer or standing last. Essentially, all that we spoke about is that, volatilities will come, wars will come, the China story will come, or emerging market story will go. These things are normal occurrences in the market. If you can stay stuck to the investment that you've made, stay invested for long, you're eventually going to be rewarded and you'll be a winner. So therefore, avoiding emotions is directly proportional to the returns outcome.
Right. One last question, Anand. If you have, I'm going to simplify this for the sake of our viewers. If you do have 100 rupees sitting in liquid, how much of that will you use to top up your existing investments?
Very interesting question and completely depends from investor to investor. But yes,
Somebody with an average risk profile, 60%, or maybe a 50-50, but 60 or a 60-40 equity debt.
so I would personally do 5 rupees STP per week.
This is in this market condition, or this is
Absolutely.
okay?
In this market condition, 5 rupees STP per week. And anytime market goes 10% down from the top, I'll double down the STP amount.
So we're down about 5% to be specific.
Almost 5 to 6%
right now. So if we get another 4%, you will put your full 100 rupees out, is what you're saying.
Double down the STP amount.
So
Instead of 5, I'll start doing.
You'll prepone the following week's STP into the current week.
100%.
Okay, Santosh, that question is for you as well. If you have 100 rupees sitting in liquid, how much of that will you upfront this week or currently? And when could you consider making a lump sum investment as well in that sense?
In the given scenario, I'd straight away double down with a 10% investment. That is the 10 rupees of the 100 will go right away in. I don't want to miss out this correction, however big or small it is. But the most critical aspect is I would ensure that the balance 90 is staggered well enough. And normally I follow a 100-day approach where I at least do 1% every day or maybe 5 to 10% a week and stagger it between 90 to 100 days, which usually in market terminology is about 4 to 5 months, because we got about 22 days in a month and 100 days will take you to close to 5 months. Now that will continue for the larger part of the 100. But since I've seen what I've seen in the short time of 7 days, I'd go with a 10% straight away.
Completely out of time, but one last one, Anant, because you talked about gold, and I want to ask you this. Gold stocks, even though they have very little to do with actually gold prices, or gold ETF, because SGBs aren't coming anytime soon.
Gold ETF or mutual funds are better.
What about you, Santosh? How much of your portfolio should be in gold? And if you've got no gold allocations, how much should you start with for an average risk profile?
Fortunately for me and for my advice, in all my investors, I've been allocating gold for the last 4 years in a row, and we are sitting quite handsomely on gold. I'm any day a gold ETF fund of fund. It's the most convenient and ease for investors to access gold, whether an SIP or lump sum, in any format of lump sum or SIP or STP. Accessing gold ETF fund of fund is the best route.
Yeah, this is interesting. As Indians, we're all fortunate enough because all of us, out of choice or no choice, have had allocations made to gold. So we're all richer today than we were maybe a few years ago. But thank you, gentlemen. Great talking to both of you. Always good to get an understanding. And thank you for calming nerves of investors who are probably very concerned given the big fall that the markets have been seeing. Have a good day and we'll see you soon.
You too. Thanks.
Thank you so much.
Well, with that, we're completely out of time on this show. Thank you for watching. But like our advisors said, you want to start nibbling into the markets. If you get a correction of 10% or more, you should upfront and double down your SIP. Of course, what you also can do is allocate about 10% of the cash sitting on the sidelines at every dip. With that, out of time. Thanks for watching.